I'm here with Sven. Sven, I've been following you for years. And the two of us have had a few dust ups here and there, arguing over certain things. But I think,
really,
honestly, I think it's all in. Good. Both of us are trying to seek the truth, I think, at the end of the day. And I think that's where when you see those collisions, there's something there. Maybe you're missing something. Maybe you got something right. And, that's the great thing about being online. But here's where I want to start with this. Welcome to the show. We're in a raging inflationary environment all around the world. And it seems like we should, or there could be a deflationary bust brewing. But then I'm looking at oil prices, and I'm looking at these expectations over in Europe for what they're thinking oil prices are going to be. I don't know what to think, right? So what are your thoughts on some of this?
Hey, Preston. First of all, glad to be with you. Did we have dust ups? I'm not sure. I think we just teased each other a little bit here and there, but it's part of the journey, absolutely. But that's a good thing, by the way. I mean, it's just maybe starting off with social media in general. You can disagree on some things, and I think everybody got to be humble enough to let their views evolve over time.
Amen.
You don't never need to be personal or anything like that. Good-natured jive is fair enough, but just go wild sometimes.
Amen to that.
Macro. Yes, Matt Preston, the macro. It's where do I start? I mean, maybe just a quick background, because I've been known to be kind of a central bank critic for more than a week or two. It's I think painful for all of us to recognize that the macro environment has devolved in a painful way for a lot of people over the years. I've been a critic on the sense that all the interventions that we've seen over the past 15 years have widened the wealth gap. And central banks, Powell himself, parading up front how central bank policies absolutely do not contribute to inequality, when all the actual evidence is exactly there on the table. It's creating rifts in society. And then, of course, the goal now to he comes out last week and says, well, now that we're producing QE and bringing out, or we're actually starting QT, we're taking the liquidity out, it's going to be bad for asset prices. So while you're not admitting that you're boosting asset prices on the way up, you're certainly now using it as an excuse why asset prices may be going down. So there's an inherent dishonesty in the entire construct, and all of us, we have to listen to all this. And these people tend to put themselves on pedestal, or being put on pedestal by the media as the great wise men and women of the global monetary system. Well, they just revealed themselves to not be that at all. They're not wise. They can be horrifically wrong, and they ignored all the cautions that were thrown at them in terms of continuing to print into an environment where we did have supply chain issues, where we had fiscal stimulus, the likes we've never seen before, and they just kept adding liquidity into what I last year obviously kept screaming about, was this massive asset bubble in everything, exacerbating housing prices by buying mortgage-backed securities when there was no housing crisis. So everything got literally exacerbated to historic degrees. And then now, of course, what happens while they ignored all this, even in December, I mean, I just need to make this point. In December, CPI was already 7%, and the Fed, in their wisdom, put out this Fed funds forecast of less than 1% for 2023. So this broad disconnect was already there. They were still living in la la land. Now, to be fair, they're not controlling a Russia invasion of Ukraine, which certainly exacerbated things. And so you have, on this inflation question, you have really multiple factors that are coming at play, and it's nasty. You had the monetary fiscal excess, you had the supply chain issues, you had the Russia-Ukraine war, which is ongoing, which is fueled energy and food prices globally, which the Fed does not have any control over. And then the other part is psychology. And we saw this in the 20s in Germany. It was just once psychology kind of feeds on itself, you risk that you have that vicious cycle, right? And then, wage growth, people demand more wages, and it just feeds on itself in terms of expectations. So it's a really dangerous time in this sense, because we are already seeing the economy slowing down rapidly. Asset prices have dropped significantly. In fact, this first half of the year was one of the worst first halves in all of history. And it got exacerbated also by the fact that not only stocks dropped, which was the standard kind of curve in the last 40 years, because bonds also dropped. So that in terms of finding a place to hide, there really wasn't any in terms of the large investment groups. And then, of course, you have a new asset class, crypto, Bitcoin, and everything got smacked, right? So the cumulative impact on the wealth effect is dramatic. And they had, since the financial crisis, they've used, and they will never admit it, but I'll just say it, they used the stock market to manage the economy. Bernanke, actually, as a former Fed chair, when he was Fed chair, he said, in 2012, when the stock market goes up, consumers feel more confident. They want to spend more. That's what it really is all about. And they constructed this over those last 15 years, intervening at every single step of the way, believing apparently that this all could be consequence free. Well, now we see the consequences unfolding. But now they're in a position where they can't rescue the stock market because of inflation still being a dramatic problem. So the question is, how do you then ultimately solve this? And how can we wiggle through it? Because, and I'll finish on this point, the Fed funds rate that I mentioned earlier, the projected Fed funds rate that they had at less than 1% in December for 23, they now have at over 3% going to 3.8% in 2023. Let me tell you something. When you build an empire of debt, totally financed by cheap money, you cannot raise rates to certain levels without you facing a major bear market, depression, what have you. So to me, this is just another Fed put that's been placed in the market, because while they're saying 3.8% Fed funds rate for 2023, they're also at the same time projecting positive GDP growth. I'll just say it straight out. That's a lie. It's just not going to happen. And the reason that's not going to happen is because we've seen for the last 30, 40 years, the Federal Reserve being able to raise rates to a lower high, to a lower high, to a lower high. Each cycle, they can tighten policy less and less and less. Why? Because the debt construct has completely blown up in everybody's face. Notice the crises get larger, the interventions get larger, and the debt requirements get larger. I mean, think about it. Back in just 20 years ago, the debt was $5.5 trillion. Now it's over 30 trillion. We just added 9 trillion in debt in 4 years. And in 2018, they couldn't even they got barely to 2.25% on the Fed funds rate. And they stopped. They stopped because the market collapsed. The recession was kind of a risk factor for them. So they pivoted because they can't handle these big market drawdowns. So now we've had an even larger bear market. Actually, it's the most extensive bear market since 2009 in terms of length. Yes, COVID crash was deep, but it was fast because they intervened. But this is dragging on. And as you see, consumer confidence, the lowest, consumer sentiment rather, it's the lowest ever. That's recessionary. So you're already risking very much a recession. And my premise in general is to say that there's no way they can get to 3.8% without a major recession. They can't raise rates into a major recession. So ultimately, I expect there will be a pivot. And we can discuss what that may look like. But
do you?
They can't do it.
So everybody's saying that they're not going to do anything until something breaks. Do you share that sentiment?
Well, first of all, they have to have. If you look at from the Fed's perspective, let's say they are in the box, like I say they are.
Yeah.
And they got the policy completely wrong. They got themselves trapped. They are in a position where they've lost a lot of credibility, and maybe all credibility at this point. It's because not only because they got it wrong, but because obviously over the years they've trained the investor mindset to always expect an intervention, and they were I would say they were genuinely scared of something ever breaking again, like during the financial crisis. So that's why we saw, after QE1, we saw QE2, QE3, and all the other central banks starting to apply this in this deflationary environment that we were in. But if you build an entire construct of growth dependent on the market, meaning market levels, I keep going, last year everybody ignored this, but I kept pointing this out. Market cap to GDP in the 70s, 80s, was around 40 to 60%. That's kind of, and it went on for decades like this, right? And we had this big tech bubble building, and we saw something we'd never seen before. It went to about 150% market cap to GDP. So the market was valued a lot more than the economy itself in terms of annual GDP generation. Then we had the tech bubble burst, and we dropped to about 75%. We went back to the normal range, if you will. That was the bottom. Then they came up with the housing bubble, right? Because they kept interest rates low, and then that fueled a new fire speculation, got to about 137% market cap to GDP. Then we had the global financial crisis, went down to 50% market cap to GDP. So these were kind of these excesses that right-sized themselves after things broke. Well, in December, they actually had lifted the whole thing up to over 200% market cap to GDP, and everybody ignored it. It's like, this is madness, right? You cannot expect to have a long-term, disconnected financial system that is not backed up by actual productive growth in the economy. So the fact that the bubble now burst is maybe a positive in the sense that, okay, we're getting back to a right sizing type process. The problem is it's so big, we're still high. We're still in the 165, 170% range. So we're just kind of sitting on top of the tech bubble at this point, right? So how do you, from a policy perspective, convince the market that you're actually serious without then actually breaking something? So this is the art of jawboning, as it's called, right? Mm-hmm. At the beginning of the year, I said, I had this article out where I talked about, okay, maybe this year is all about gaming the Fed. And if I were the Fed, what I would do is I would jawbone and get the market to tighten for me as much as possible, so that actually I don't have to raise rates to the point where I break things, but everything, let stocks fall for once, right? Take the excess demand part of the equation, demand destruction, create, slow it down. Mm-hmm. And then when the time comes, and do all this without actually causing a crash, right? Mm-hmm. And interesting enough on that point, this is so strange about how this market's been acting this year, is because we made lower highs and lower lows, lower highs, lower lows on the S&P, but so did the VIX. The peak spike was in January. I was baffled, I got to tell you, and I think a lot of people are probably baffled that at the June lows, when we went into the 3,600 area, the VIX was again making a lower high. You would have expected in standard market functioning, you would have some sort of capitulation VIX spike. No, and we can discuss that separately. It's kind of an oddity, because it almost makes it feel like this whole thing is a bit controlled. it's like it's managed in some way, and I'm not saying we can't have a massive X spike still, because I actually long term still see that coming, but I just, in terms of market behavior, I find that very, very odd. So if that was my theory, that they're going to let this happen with jawboning, then this was all going according to plan. Again, Russia, Ukraine, I think, made things a lot more difficult for them because of the energy price and food price inflation component. And this is now where they're probably trapped, because, and this is where the actual narrative doesn't make sense. And you actually heard Powell admit to that last week, because he was challenged on this. What we do in terms of rate hikes is not going to impact energy or food prices at all.
Yeah.
And so this is the perversity of this all right now. So if it's not impacting and no benefit to the consumer, then why are you now smacking everyone on housing and everything else? Because let's face it, it's going back to this wealth inequality piece. The bottom 50% did not benefit from all that money printing in the run-up of asset prices. If you don't own assets, you don't see asset price appreciation. You don't. And so this Druckenmiller talked about this last year as well, in terms of how they're really just benefiting the upper tier of society, especially the top 10%. And we had it with data. You can see it, 89% stocks, or 89% of stocks owned by the top 10%. It's a no-brainer. So they really benefited from this. And the bottom 50% also got hurt because they were increasingly priced out of the housing market. And then now they got inflation. If you're in the bottom 50%, inflation, food and energy is hurting you more than someone that's in the top tier income. Higher gas prices, okay, I've paid more in my tank, I don't care, right? It's just a minute part of my monthly expenditure flow, right? That's unfortunately the reality of what's been happening. And then now with housing, rent prices have been obviously screaming up as well. So you just get beaten down more and more if you're in the bottom 50%. And those two stimulus checks, they didn't help you, in the sense that, okay, they helped you while the crisis was going on, so it kept you afloat. Worst case, maybe you got caught up in the bubble and put it in some shitcoin somewhere. That's just reality, right? So now inflation is going to continue on the food and energy front until we see some sort of solution with Russia, Ukraine. And if the Fed is not really careful here by continuing to raise rates, and then they're going to break something. Yes, they're going to put us in a major recession, because they're making everything else more expensive, right? They're making
Does the next response, does it come in at the same size of COVID, or are they going to try to do a much smaller response because they know that if they do something substantial, that the inflation prints are coming right back, and maybe with even more magnitude?
Well, this is the interesting part, because I think we all need to be just humble, understanding that this is all a really unique set of circumstances, and I don't think anybody has a clue how this can play out. The standard script is, we go into recession, they're all going to go back to printing, because they have to. As I mentioned, over $30 trillion in debt. The Wall Street Journal had a piece out this weekend, I think, that the cost of servicing the U.S. debt has already increased by 30% in the last year, and that doesn't even account for the latest rate hike. Okay, it's just the minuteness of the rate hikes and the financing conditions. So again, if you go to 3.8%, what are we talking about? There's, on the one hand, they say the debt is not sustainable. Both Yellen and Powell have been saying this for years. On the other hand, they put in the conditions where that continues, and so now this. By the way, someone may say critically of me says, "Well, you were ranting about them not raising rates for years, so why are you now critical of them raising rates?" I'm not critical of them raising rates. I'm just trying to be realistic about what this implies to the debt construct and the economy that has been made so dependent on asset price inflation when it doesn't have asset price deflation. right? So the the short answer is, I guess, it depends on how inflation evolves. I think, and we're all looking at the negative side. Maybe we can also look at what a potential positive could be. If energy and food price inflation are so tied to Russia, Ukraine, and that being a geopolitical event, what if that actually solves itself? I know that seems completely unrealistic at the moment, but let's say they do come to a political situation, and I can come up with a scenario where that might happen. Then all of a sudden, just inflation is going to collapse on that front. On the commodity side, look at copper, massive bear market already, aluminum, lumber, all these kind of commodities, they're already dropping hard, big time. So if we're looking at data this summer, I think we need to keep an open mind in terms of how this can evolve, because there's obviously the consumer part of inflation, but then there's also core inflation, what the Fed looks at. Mm-hmm. And so you get one headline on Russia, Ukraine, and then it's over. And then given how positioning is at the moment, which is some of the most negative I've ever seen, because people are, I mean, Jesus, I mean, that happens at every bottom, but, yeah, people get really bearish. In fact, the AAII bull bear ratio right now is some of the worst since the 90s. It's worse than the global financial crisis. It's worse than it was during the 2000 tech bubble burst. So I think people are not prepared if there's any good news coming in the sense of positioning and how vicious actually a comeback rally may be. And then all of a sudden it just disappears, right? Because then you're looking next year at massive retrace numbers in terms of the inflationary component, and that gives them room to basically stop, and then basically if you have some good news with COVID, in terms of, today, China announced they're easing restrictions again, supply chain easing, and then you can go back to some sort of normal. And keep in mind, the market is already pricing in rate cuts for next year. So while the Fed is talking about 3.8%, the market's already saying this is a short-term thing. So you got to be mindful of that as well. How that plays in terms of timing, nobody knows.
How are you looking at real estate right now? Because with these rates and the speed at which the rates have occurred, so we've gone, here in the U.S., just call it generically 3% to 6% in real estate rates. I'm not sure what it is over there in the U.K., but it almost seems like that the economic reality of that has not hit the market yet, or that it's just about to. So what are your thoughts on that, and the timing of how some of that might play out?
Yeah, so first of all, let me say, since the global financial crisis, we've been trained to expect bear markets to only last, at the most 6 to 8 weeks before the next round of intervention comes in, right? This one's been dragging on. Actually, started in November. That's when everything peaked. The S&P peaked in January, but small caps, everything else peaked in November, and it's just been going on. So we're already in the most extensive bear market that we've seen since the global financial crisis. But bear markets can also last for years, right? We've not been there, and I think the question here for us now is, okay, going into the second half of the year, if we do see improvement in inflation, can we actually get out of this phase here now, or is there the big second shoe to drop? To your point, real estate, and that's the problem when you build an everything bubble, right? Not only a bubble in stocks, crypto, you can argue, but in bonds, we clearly had a bond bubble, but also in real estate. This is why I've been so critical of the Fed, because they bought like $1.9 trillion in mortgage-backed securities into a red-hot housing markets, a policy that was designed to bail the housing market out. It in a low supply type of environment, the housing market clearly can't handle higher rates either. It just can't. I mean, if you got a 30-year mortgage at 2.5%, great, but now you're looking at 5.5, 6. it's just going to kill demand, and it's could kill the construction side of it, because if you don't have demand, then you're not going to invest. And if you're all of a sudden you're paying a lot more, to finance your projects, you're not going to take that risk. So they're looking and staring at a complete collapse there as well. How is that helping the consumer, right? The upside to this, it could make things again more affordable and to get some sort of balance. The big issue is what you raised, which is the speed, the velocity of what has happened with yields. So I want to raise that issue real quick, because I think that's really important. 10-year yield, to me, is one of the most important charts out there, along with the dollar and the junk yields, if you will, junk J and K. It's junk is an interesting chart. That chart actually is on a point where you would intervene typically. In fact, maybe the whole system right now is, we're in a situation where typically they would intervene to save everything, but now they can't. But the 10-year yield, I mean, that flew higher this year, like we've never seen this before in terms of velocity at all. Last year I had this chart out. You may recall this inverse pattern. It was like in October was around 1.5%.
Mm-hmm.
I had an inverse, had a technical target, and it got to 3.2%, hit it on the nose, then retreated. That was the point when we saw the market rally in May. Right, it had made a new low, and we saw the 10-year retreat, market rallied. Then what happened in June is the CPI numbers came out, 10-year freaked out, made new highs, went to 3.5%, markets dropped to lows. So when you have just making a technical comment here, is when you have a technical pattern play out, like we had that inverse going from 1.5 to 3.2%, the pattern has played, and then you wait and you look, okay, let's see if we can get a new pattern. Now we have a new pattern, because we're building this really tight rising wedge on the 10-year, and the 3.5 that it hit in June hit the top of the trend line, now reversed, and guess what? We're seeing a rally in equity markets. So that chart is super important conceptually, because it goes to what I said at the beginning. This debt-laden system cannot handle higher rates. 3.2%, by the way, was where it stopped in December of 2018. Excuse me, in the fall of 2018, 10-year hit 3.2%, markets fell apart, Fed flip-flop. That was the end of it. That was with $8-9 trillion of less debt. So we cannot be in a situation where the 10-year continues to hover above 3.2% for an extended period of time. So if they want to really avoid a severe recession and a soft landing, the 10-year must come down. It must come below 3%. And then this was going back to my earlier January concept. If they wanted to just jawbone the market, let the market tighten, let the market over tighten as it now has, and then they come and see the 10-year reverse and have the Fed meet it somewhere in the middle. So instead of a 3.8% Fed funds rate, maybe they'll stop at 2.5, 2.6, 2.7. And that's the end of the tightening cycle. So I'm wondering, as I'm watching this now, and the 10-year having a reversed again, it has the tightening cycle from a market perspective already peaked, as the market is starting to price in a recession risk coming, right? And then that's the pivot. But we won't realize it until after the fact. It's just in the here and now. You can make observations. All I said is, if they can't get that done, and the 10-year keeps flying higher, we're going to keep making new lows in markets. If the tightening cycle has peaked and the 10-year is now going to break its uptrend pattern, you're going to have a massive risk on asset rally, because again, positioning, negativity, and relief, frankly, because that then says the worst is over. And so I think we're just going to need to be cognizant that things can get a lot more violent, not only to the downside, but also to the upside. That's why I'm kind of making this bear market rally case.
Hey everybody, Trey Lockerbie here from We Study Billionaires, and I wanted to tell you about a new company that I absolutely love, and that is called Trade. Trade combines two of my favorite things, coffee and technology. So what you do is you go to drinktrade.com. There's a super simple survey that you take, and then it tells you which coffee they're going to send you that you are literally guaranteed to love. Meaning, if you don't love it, they'll send you a new bag of coffee for free. And from there, you can keep experimenting so you're not falling into the same rut of drinking the same coffee over and over and over again. There are so many different types of roasters, levels of roast, beans from different parts of the world. There's plenty to nerd out on here. So why not be adventurous and try some new stuff? After I took the quiz, they sent me a bag from Sight Glass Coffee in Northern California, and it's literally my favorite coffee of all time. Normally, I've been drinking a coffee where I have to sweeten it with honey and almond milk, but this coffee, I could actually drink it black. It was so delicious just on its own. And right now, Trade is offering subscribers a total of $30 off your first order plus free shipping when you go to drinktrade.com/TIP or click the link in the description below. That's more than 40 cups of coffee for free. Get started by taking the quiz at drinktrade.com/TIP and let Trade find the perfect coffee for you. That's drinktrade.com/TIP for $30 off.
Yeah, it's fascinating when you're looking at, especially a lot of these treasury yield curves. The one that's got my attention right now is over in Japan. They're trying to do yield curve control. And you're seeing,
aren't they always?
and I guess I'm just trying to understand how that all plays into the broader markets, because if they're doing the opposite of Fed policy with their yield curve control, and it seems like they're working very hard to keep the yield peg in place. How does that play into the calculus, the global calculus of everything that's playing out? Because they're adding units, others are aggressively tightening units, monetary units in the system. So how do you think through that, and like what, how do you add that into the overall scheme of how you're optically viewing where this goes next?
Well, first of all, we've seen over the last few years several times where central banks were polar opposite in terms of policy. Right? We had that in 2017, 18, when the Fed was raising rates and reducing their balance sheet while the ECB kept printing, right? And Japan kept printing, and they kept rates negative, right? So that's not unusual. What then obviously changed the equation was you saw that with overnight repo. Overnight rates also jumped in the US, and also they brought this whole repo program in to keep things under control. Maybe Japan is kind of in that situation now, in the sense that the entire globe is moving towards tightening. Obviously, their policy is completely out of sync with that, and now obviously requires more and more intervention. The question is how long they can keep this up, and that's the problem with permanent intervention. You creating a financial system that's disconnected from fundamentals in a big way. Japan, Kuroda, and they've done nothing but print for years and years. So I think right now they're very desperate. What you don't want to see actually is them losing control, because I think that could break something globally. That's clearly a risk factor, right? Because that would push yields higher all over the place if Japan lost control. So I think this timing now between the summer and into the fall is very critical, because if I'm correct in saying that the 10-year may have peaked, which I don't know if I'm correct, and we're dropping lower on yields and we're getting support from inflation data in terms of new CPI and PPI reports coming in July and August, then that actually takes pressure off the Bank of Japan. You heard the term widowmaker, right?
Oh yeah.
People betting against the power of central banks, and Bank of Japan and specifically, they do have the ability to create money out of nothing, right? They have an unlimited supply. So, I think there are a lot of people scared that if they're going to try this again, betting against the Bank of Japan, they're going to get railroaded again, right? Yes. So basically what I'm saying is there's risk in the system and everything. We have central banks fighting for control, trying to get a hold of the narrative on inflation. Part of it may just simply be public posturing. The concern is that indeed they are going to break something. And maybe on that note, I should say, just a personal observation here. Given the amount of carnage that we've seen in not only in indexes, but specifically in stocks, where we've seen stocks dropping 40, 50, 60, 70, 80%. I'm actually surprised we haven't seen a major blow up yet by anyone.
Yeah, I know.
That brings me back to my earlier comment about this all seeming very controlled.
Yeah.
Traditionally, I've been known sometimes to be a bear. Traditionally, I would say, this is the perfect environment for something to blow up and get really ugly. But it's so calm. It's so, steady.
In traditional markets, for sure.
In traditional,
relative to the digital asset space is a disaster. But growing pains.
Major
disaster.
Major disaster, yeah. So now what I'm saying is, okay, well, look at the ARKs of the world. I mean, there's Facebook, forget ARK, these are major FANG stalwarts of the bull market. Netflix completely destroyed Facebook. And that so many funds were highly exposed to this. Yet where's the drama? Where's my big VIX spike? So if I see the market making lower lows, it's more fear is building. But what I have been seeing this year is the S&P makes lower lows and the VIX makes lower highs.
Do you think, Sven, that some of it has to do with there were just monumental gains made in the preceding years since COVID? I mean, there was a year and a half that, you had a raging bull market where, people just crushed. People made what they would typically make in a decade in that short 1.5 year time frame in financial markets. Is this the reason why we aren't seeing because I'm with you. It doesn't make any sense to me that we haven't seen something really kind of explode in traditional markets. But do you think that that's why?
Well, it comes back to leverage. Look at margin debt last year. It just blew higher, far beyond what we saw in 2000 or during the housing bubble. It's absolutely massive leveraging on the side of retail, for example. The one stat that just blew my mind last year was that last year alone, more money flowed into stocks from retail than in the previous 2 decades combined. That's an insane amount of money, right?
Yeah.
And so did they all sell the top and living at the beach? I don't think so.
No.
Right? All right. So there is pain out there. And that's what I was saying. I think maybe and this is the worry I have, is the Fed again making a policy mistake by underestimating how much pain there actually is out there. And we see that kind of with the savings rate as well. This is one of the things that always irk me with central bankers, this sheer leading right up until the bitter end. Remember Bernanke 2008, there is no sign of a recession. Subprime is contained, before blowing up in everybody's face. And then he got renominated as the hero, right? Because he intervened. And then we saw this last year again with every one of these guys bombarding markets all year long saying inflation is transitory. They literally promoted this risk-on environment, and the S&P was just a tracker of the Fed balance sheet. So now we've dropped over 30% on small caps, NASDAQ, and if it wasn't for some of the specific stocks, and especially energy holding things up, because that's where you're seeing gains, that actually underneath the damage is a lot more pervasive. So to me, the notion that all this is consequence free and we can have kind of a soft landing here with rates staying as high as they are, to me is a fantasy construct. So something needs to give very shortly here in the summer. Otherwise this fall is going to be a show to remember.
Yeah. No, I'm with you. I had a question come from the audience. This one's from Eddie. He wanted to know if you found technical analysis harder over the last few years, given the Fed's massive influence on the markets. And then, Sven, if you don't mind, as a follow-up to that, just give us some of your thoughts in general about technical analysis and how you find it as a tool for maybe a beginner investor or somebody who's just kind of new to the space.
Okay. So first to Ed's question, I find technical analysis to this day to be incredibly helpful. I mean, look, maybe mixing the answer with the other question you had about technical analysis in general. Technical analysis is not a guarantee. You know, it's not a tool that guarantees you anything. You can still be taken out on positions. And that's why people sometimes call it voodoo or squiggly lines and this, that, and the other. What technical analysis to me, anyway, is we're all in a position of great uncertainty, right? Anything can happen at any time. But it helps us identify a positive risk reward. For example, do I want to continue pressing long here in this technical setup? And this could be on the charts, on the signals, on the positioning. It's a whole heap of tools, and you can make this really complicated, which I don't like. I'd like to actually keep it very simple. KISS, keep it simple, stupid. That's one of my wife's lines, and she's been just marvelous at this. And I can go through all kinds of tools, which we don't need to go through, but I'm saying when the search is to find what the market deems relevant. It keeps us honest in that sense, because we may all have opinions and we may have biases, and we want this to go to 1 million and and this to drop 100%. That's just not realistic. But it helps us keep us honest in the sense that we can say, look, this, what we can debate all day long why, but it is relevant to the market. And if it's relevant to the market, it has to be relevant to me as someone's trying to position for a profitable trade, right? And it's going back to Ed's question specifically. I gave you one example. This is really recent. This was here in June 16th, 17th. I posted this chart on Twitter about the broader NYSE index, right? One of the most powerful tools to me in technical analysis is confluence, where, there's not one particular point that on a chart that's of interest, but rather it's multiple things happening at the same time, which I found fascinating. And in NYSE specifically, it was the weekly 200 MA. It was the February 2020 highs, and it was the 38.2 FIB. And they were all in the same zone, which to me just screamed confluence, support. So is that to say a guarantee that NYSE does not drop lower? No, and I pointed this out on Twitter. I said there's a lower gap below. This area doesn't hold. But I also said this is an area of confluence that would be of interest for bulls to take a major stand at, because it had all these areas together. And guess what? It did. I keep tracking that chart. It just bounced right off there like a rocket. Right? So technical analysis absolutely matters. Now, to be fair, what we see when all these interventions over the years, I've come to realize that the extremes become ever more extreme, to the upside as well as to the downside. When you have too much fluff in the system, the down moves can be absolutely awe-inspiring. And there will be times when, technical analysis also gets blown out. It's not as I said, it's not a guarantee. You just got to be aware where the control pivots are, and then figure out if that is a trade worth taking from a risk reward perspective. Stop management and all that. Not financial advice. Just no, it's a tool, and we got to learn how to use the tool. And keep in mind, banks use technical analysis. They have whole teams of technical analysts. They're basing on all this as well. It's some may call it a self-fulfilling prophecy, but it's not. I mean, yes, a lot of people are looking at different things, but it makes sense because the market is sensitive to it and is reactive to it. And our job is to find out where those points are and then use those points to develop a positive risk reward entry point. And the final point on this, and I freely admit this, when you're in a heavy printing environment like we were last year, the sell signals often get washed away. It's very tricky, but it comes back down to the simplest things. And trend lines, for example, are very powerful. Yeah, you can get a spike over, you can get a drop below or whatever temporarily, but markets really respect this as well. And as we got into November, December, the S&P was screaming against a long-term trend. The NYSE did as well, and it just kept stopping there. Like every time it dinged it, and while the Fed kept printing, that correlation was there. So every time it dinged, it was definitely worth an effort to get a sellout. And we got these occasional drops. They weren't very dramatic, but then once the trend broke, all hell broke loose. Right? That's why it's an art form, I would say, to mix technical analysis with what's going on the macro front and what the trends are, and then present a comprehensive picture of how you want to approach this from a trading perspective.
As a guy who started off as a value guy exclusively, I was very suspect of anything technical analysis related, but through time, I found that things that have a larger market cap, or if I can kind of look at a sector by combining equity indices or whatever to manufacture a larger market cap collectively, I find that there's a lot of signal, like you're saying, probability-wise, in using technical analysis when I'm dealing with a larger market cap. When you're looking at like smaller market caps, I think it's just so volatile and dependent on like much smaller factors that are hard to predict or forecast based on looking at price exclusively. So, yeah, no, those are some interesting comments, and I really like your comment about the confluence. I think that's an important factor for people to think about. Sven, so you seem to be more amenable, is the word I'm going to use, to Bitcoin playing a role in potentially the resolution of a lot of this, craziness that we're talking about with respect to central banking policy. In general, what are your thoughts around it? What kind of played a role in some of that change of heart, or maybe just looking at it a little bit differently?
Well, as you said at the outset, we had a couple of little dust-ups, at the beginning. Now, look, it for me was an evolution as well. Part of my capitulation process was my wife kept beating me up over it. She's been a long-term bull on Bitcoin. To me, analytically, at the beginning, I obviously, saw the run up in 2017 to that high and then that complete collapse. Looking at the technology, wasn't clear to me that central banks would actually ever allow it in terms of being independent monetary system. Let's face it, at the end of these guys all are monetary North Korean dictatorships. They have complete control over the monetary system. So why would they actually allow this to happen? And maybe with regulation together, they would squash the whole thing, right? Mm-hmm. And then of course we drop from 17,000, 20,000 to 3,500. Mm-hmm. And that was the first kind of the big pain wave. But then also looked at it from the human component in terms of where you actually see development happening. It's actually working from a technical perspective. It is very clearly defined, and you see people like Jack from former CEO of Twitter, getting heavily involved. And they're smart people, and they're doing a lot of things around it. Then the regulatory path started evolving a bit, where I started realizing, you know what, they can't shut it down.
Mm-hmm.
They can't ban it. I mean, they can make it difficult, absolutely, but no, they can't shut it down. But then at the same time, I saw, as you know, it's talking about this massive asset bubble. So I saw all this other stuff coming about that reminded me very much of the 2000 tech bubble, the fluff, the overexcitement, the emotions along with it, the recklessness in some cases in terms of behavior. As you know, we got spammed to hell with bots and everything else. These are kind of all the negative components. So in terms of an asset bubble, I was very concerned that everything could blow up in that sense. And I started talking to Michael Saylor last year. I had 3 discussions with him. The first one, then I was kind of coming from the point of, okay, let me try to poke holes in the whole thing. And during that discussion, this 2000 tech bubble aspect came back in my mind. And Michael and I talked about the components. We had obviously stocks get completely obliterated in the wake of the tech bubble, including Amazon, including Apple, and all. I mean, they dropped 80-90%. But, and this is the hindsight equation, are you looking at business models that are sustainable or that have the potential to have a global dominance and footprint? And clearly, in hindsight, we know the Apples and the Amazons of the world were exactly that, whereby, pets.com and all that stuff completely blew up. So then that became of interest to me, because I said, okay, well, let's look at the space and what do I see as a winning business model long-term in that construct. And that's where, when you are in an asset bubble, you want to see how this all falls out, right? Mm-hmm. And we just saw that. We just saw this year. In January, I had my second discussion with Michael. I made my first nibble at Bitcoin when it had dropped. I think it was down to low 30,000. So just a little nibble, because I was still in the full cognition that we're still in an asset bubble. And I pointed out the charts, going back to Ed's question earlier about the relevance of technical charts. One of the things I always liked about Bitcoin, and I've said this for the last year and a half or so, that I like that it acts very technically. Mm-hmm. You can actually chart it beautifully. And I've been pointing out Bitcoin on the Northcast for months and months. When I see bullish signs, I point at the bullish signs. When I see the negatives, the bearish aspect of it, bear flags or whatever, it plays it. It plays it really nicely. In fact, this last few weeks, when the markets dropped, Bitcoin, my third discussion, Michael Saylor, I talked about the 17,000 level. We dropped to 20,000. I said 17,000. There's a major trend line there, major support trend line, and that's the immediate risk. But as long as it holds, the trend's intact. Guess what? We hit literally that weekend. We hit 17.5, tagged the trend line, and have bounced from there. Not saying anything is clear, but it's all part of a process to me. And if we were to drop that trend line, boy, folks, things can get a lot uglier. Okay, just be absolutely clear on that. And I said that's in January. You can make the case, because there's a larger macro trend line that points down to 6,000-7,000. I'm not predicting anything. I'm just looking at the overall risk. That's why it's so important whether we are now in a structural bear market that lasts for a couple of years, in which the cases can happen, or we're coming out of this and this will have been like a first half of the year scare, because, and that's the other thing I've been pointing out for the last couple of years, is the asset correlation is massively high between the S&P and Bitcoin in terms of the directional flow. In fact, in recent weeks, it got to like 95%. In my case in January was, what's missing for Bitcoin is that regulatory framework, because from a demand perspective, I think there's a lot of funds that are professional investors that want to get into Bitcoin, but they don't have the regulatory clarity, and they can't actually invest until they do have that regulatory clarity. So if I look at this, then I see a bear market. I see an asset bubble that's popping. I see business models getting crushed left, right, and center in the crypto space. I see the fluff coming out, which I think is a positive thing, because once you had the creative destruction, then you can have that longer term view in terms of what will maintain, what will be sustained. You heard Gary Gensler from the SEC yesterday saying, considering Bitcoin a commodity, it's kind of singling it out, which is of interest as well. So you're looking, the Twitter handle is Northman Trader, not Northman Investor. But in terms of Bitcoin, I do see it as a longer term hold for me. So that's why I outlined in January, I want to kind of use this year with the view that an asset bubble could be bursting. I'm going to use this year as a kind of slow, patient scaling in strategy over time. 20,000 was a level I mentioned in early January as well. That was kind of a key support line as well. So now here we are. So it's part of a process, and I think long term it's very positive for Bitcoin. Now, of course, if you bought at 50, 60,000, and you're writing this down, this is no fun, right? That's why I kind of stayed away from that psych hype at the time. So, sometimes, by the way, just a general comment, I think for anyone, whether you're a short-term trader or a long-term trader or investor, the biggest skill I find that I continue to teach myself is patience. That's why, for example, if I were really patient, I just maybe trade 2 or 3 times a year, wait like for the big confluence points to come together.
Yeah.
But, we're also creatures that want instant gratification, yes, right? Yes. So we get trigger happy on the finger. But that's one thing I learned over the years, to just be a lot more patient. But at the same time, when a setup hits, fight for it too. Because things will be volatile. It's not like, okay, ding, here you go. You got to be willing to sweat it out, because that also happens at key points. Be persistent but disciplined.
All right. So here's my last question. So you spend a lot of time in nature.
I do.
You're out in nature, and I love the pictures. I love the memes also, but I love the pictures that you post. What is it that you have learned from nature that you apply to your stock investing and just kind of the way that you optically view markets?
Well, it goes back to this patience thing. Nature, I live here. I'll just put this out. I live here out in the countryside in England. It's absolutely lovely. And I love England, by the way. I just moved here a few years ago, 8-9 years ago. But it's an amazing place because everyone over time wanted to come here. The Romans did, the Anglo-Saxons, the Vikings, the Normans, and you get to see all these places that have been around for a very long time. And that kind of don't want to get too philosophical here, but it helps really keep the macro in perspective. Things change over time, but they also stay the same. And it helps me actually. Just the beauty for me is I can just step outside and I'm in nature. We're forced to stare at screens long enough as it is, right? So it's a nice outlet here. I love it. So wouldn't want to be anywhere else at this point. Although the winters are rough.
Yeah, but you know what? Right. You can. Do you snow ski at all?
No, we don't get snow in England. We get rain.
You get rain.
We either get cold rain or freezing rain.
Oh man,
that's where the wood chopping comes in, because we got a nice wood burner. Got the axe out.
I love it.
Yeah, it's good. It's good stuff. So
that's amazing stuff. Complain. That's amazing stuff. Sven, I really appreciate you coming on, and I've been a fan for years. It might not have seemed like it at a few moments, but I'm serious. I've been a fan of yours for years, and just I love how succinctly you can get to the crux of what's important in the markets, and you can do it in a single tweet or a single chart. that I think everybody that follows you, when they see it, they're like, yes, that's the chart right there. That explains exactly how I feel right now about these market conditions. And it takes a lot of skill and a lot of knowledge to be able to pinpoint things like that. So such an honor to talk to you. And I really appreciate you taking the time to come on the show and have the conversation. And
Preston, it was marvelous. Yes, go ahead.
Oh, no, I'm sorry. And give people a handoff to your content and things that we can put in our show notes.
Oh, yeah. I mean, obviously, the website is northmantrader.com. I also have the Northcast out where I try to explain charts, what I see in terms of markets. And, of course, the Twitter handle at Northman Trader. And I do sprinkle sarcasm into my tweets. Sometimes that doesn't work because people don't get that it's sarcasm. I had some person, attorney from Florida, got upset with me yesterday about a little sarcastic tweet, but that happens. So sometimes it's lost in translation. But
yes,
I try to look at the end of the day. What I try to do is I try to keep it real. We are in a complex world. I try to add some humor in it, but sometimes the humor just writes itself because I just need to comment on what people actually say or do and versus what's actually happening. So it's kind of it's an ongoing comedy show, and I what comedy is good for us. I think humor is helpful getting through complex times, but it also helps make the point about what is said being whether it's being done. And in general, I am a bit, I guess, woeful about how this has all been evolving over the years because people are getting hurt. This is we say it's made fun and giggles. It's not. And inflation right now is hurting a lot of people. And this wealth inequality issue is strenuous because we're seeing it in politics now. The tensions are high and society gets ever more divided. That's not a positive thing. Mm-hmm. I don't think things would be as extreme if we didn't say the middle class shrinking decade after decade after decade. It's a challenge. So yeah, we keep it light but real. That's the deal.
Well, I really appreciate you taking the time, and we'll have links to all your stuff there in the show notes. And thanks for your time today.
Preston, brilliant. Thank you very much. Enjoy the rest of your day.
Thank you, sir.
Cheers.
Cheers.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.